I'm pleased today to be interviewing Nathan Torinus. Nathan owns TOR Wealth Advisors. Congratulations, you've had a 20-year business career, 10 years in wealth management. You went to Harvard. It's great to have you here. Maybe you can give some background on how you got to starting your firm and tell us a little bit about TOR Wealth Advisors.
Yeah, thank you. Appreciate you inviting me here, Joe, and the relationship that I have with Graceada. I really fell in love with the wealth advisory business in part because I get to wear two hats. And so there's an opportunity to connect with clients, understand their situation, and help them build a solution that provides financial and emotional security. That really scratches my itch and my personal mission on this planet, which is to create safe feeling intimacy in the relationships that I have. In addition to that, I get to wear the hat of building a business. And the idea that in this industry, I could continue to wear both of those hats for a long time, even as the firm grows, and to have some connection with clients and building new relationships, as well as taking care of longstanding relationships, while also being able to build a firm and be strategic, that for me is just a really happy place. And for a long time, both before I was in the wealth advisory business, back when I was in manufacturing, sales, marketing, strategy, and then my first several years in the wealth advisory business, I kept trying to figure out how to make that work in somebody else's firm. Mm-hmm. And, I think if you ask any of my former colleagues, they'd probably tell you that I always acted like I owned the place, but I only owned a small share. And that's not the same. And I finally got to the place where I realized that I should stop trying to act like I own the place in somebody else's business and take the leap and set up TOR to be able to exist in that place at the intersection of my mission, what I'm best at, what I like doing, and what the world needs, mm-hmm. and also be able to deliver on that deeply held conviction that I have that our communities are strongest when business owners are healthy and showing up as their best selves, when they're good employers and bosses, when they're philanthropic, and when they have that emotional and financial security to go out and be their best selves. And so TOR is really about helping our clients be in that place. And hopefully by extension, our communities are going to be that much stronger. And so finally happy to declare my own firm, mm-hmm. where I can have a match between the way I act and the actual ownership structure and authority and discretion to take it in the directions that I see best for clients in our communities.
I've always heard this idea that clients and employees reflect business owners or reflect the leaders of the firm. Mm-hmm. So I guess the question is, how do your clients reflect your personality? Like what attracts them to you and you to them? And how is that different from what might happen at other firms?
Yeah, that's a great question. It's a good insight. One of the happiest things about this industry, and I suspect perhaps not too different for some other professional service industries, but very much about wealth advisory, it's a very intimate and emotional and personal conversation that we're in with our clients. And we're talking about sensitive topics, not only their net worth and their earnings, but also their goals and their possibilities and their inadequacies. And if it's a relationship with a couple, then there also is this interplay between the two of them and where the priorities and the goals and the disagreements emerge. And so, one of my superpowers is being able to invite intimacy in a relationship and in some cases relatively early on in a relationship and make that feel safe and comfortable. And so one of the beautiful things about being in this industry is that clients who respond to that invitation to a more intimate and deeper relationship where we're going to work off of our values and really kind of share our vulnerability with each other, those are the ones that become the clients and stay because they value that. Mm-hmm. And the ones that don't value that either never grab onto it in the first place or they prioritize other things. And so they end up migrating elsewhere. And that's a really happy feature for them and for me, mm-hmm. right? And so I end up with a group of clients, and our firm does, that resonates with what we're all about. And it makes me really happy to work with clients that care about the same things. And it also makes me really happy if we end up with one that's not a good fit, to see them go elsewhere and find a better fit somewhere. And I think it probably reduces stress for everybody involved.
Yeah, What's the cadence? I mean, intimacy is a really strong word. How do you build that over time, and how often do you meet with your clients,
Yeah.
or how do you build that?
It very much depends on each client, right? So some clients are already in a place where they're maybe thirsty for that, and the minute that they get that invitation, they're like, "Oh yes, this is where I'm want to live, and these are the relationships I want to be." Other clients, maybe they warm up to it over time, and almost always it's the case that the work is the most intensive in the first 6 to 9 to 12 months, because oftentimes clients have a lot of incomplete items on their to-do list. In many cases, they're aware of the to-do list. In other cases, they may not be, but as we work together, we reveal some stuff. And so usually it's most intensive at the early part of the engagement. And that's really true for any client, whether they're smaller or perhaps a little bit more complex balance sheet, higher net worth. But the firm is really set up going forward to target those emerging high net worth individuals who are coming to a space where they realize they need to level up their game, and they suspect that there are better ways to operate than perhaps what they've been doing, and also that their needs have changed. And so now they've got better income. If they've had a business that either they've sold or are about to sell, they're going to have new levels of complexity and needs. They probably need to step up from the estate planning attorney or the CPA that they've been using, and their appetite and need for a broader range of investments and more sophistication in how to decide is more than just what your standard advisor and your standard 60/40 portfolio might offer. And so those clients have an ongoing set of needs. And at TOR, we've decided to offer a subset of family office services for those individuals between that 5 million and 50 million net worth who aren't going to go out and hire some sophisticated private client group, private bank, multifamily office out of New York or San Francisco and pay them several hundreds of thousands of dollars a year. But they need more sophistication and are willing to step into a place and needing to step into a place where that's available and pay for the ability to have a fractional expert at their demand, a fractional CFO, if you will. And so then those clients have an ongoing need that's a little bit broader and deeper, and we're setting up for that.
Seems like you have a broader array of products than maybe other local firms have.
Yeah.
I mean, how did you build your array of products? How do you craft the right product for each client?
Really just listening to what the client needs are and following my nose. It's one of the blessings of having my own firm. If I detect patterns in client needs and demand, we can sort of move in that direction, right? And so really clear that clients needed a more sophisticated capability on tax planning, both for events like a sale of business, but also for estate planning and estate taxes. And so having the right group of CPAs in the mix and, in a future state, potentially having a really sophisticated tax ninja CPA on staff, right?
Yeah.
Same with estate planning attorneys, right? Having a stable of people that are really capable of setting up the right structures. That's a whole theme that people need. But also a broader set of investment capabilities and due diligence on clients' deal flow, whether that be in angel opportunities, venture capital, private equity, but also commercial real estate in all of its shapes, forms, and wrappers. And so as I followed client demand, getting more capable and having broader offerings in commercial real estate clearly emerged as a need and an opportunity. And that's part of how we built our relationship, right?
Yeah, maybe speak to that. What was the journey for us to get involved?
Yeah. One of the ways that the deal flow conversation works with clients is that they'll bring me things that hit their desk. And then if I find something really good and have done all the work and I think it's an opportunity for other clients, I'll take it back out to them based on their interests and appetite and risk tolerance. And that's how this Graceada conversation worked. I have a client who was looking at your Fund 3 and wanted to know whether I thought it was a good opportunity, not only on its own, but also based on his portfolio and the other investments that he had and his liquidity picture and sort of tolerance of risk. And so I got my sleeves rolled up, and the more I looked under the hood, the better I liked what you guys were doing. Not only your investment thesis, but also your track record of execution. And on a deeper level, just the way that you and Ryan and the team carry yourselves and your value system. And, in finance and in deals, there are all these little moments along the way where an opportunity pops up to understand whether corners are being cut or whether we call that good enough. But really maybe, it should be, tighter. And, I think one of the things that you and Ryan responded to with TOR is that we kept finding with each other that those corners are not cut.
Yeah.
And so I think that made it even easier to consider a deeper relationship between our firms. And for TOR to stand up a separate business that that is raising a fund and investing in commercial real estate, with Graceada being the principal investment, that was a gamble for us as the first time for TOR to do this. And if I had picked up any red flags along the way around that corner cutting, I wouldn't have made this move to set up TOR Partners with Graceada as the investment. And so I think it scratched that itch around client interest in commercial real estate, and an efficient way to do it, but also something that I could feel really good making a strategic decision, for my firm and my clients.
What's surprised you about being a business owner? You spent 18 years involved in other businesses, and now you're doing it yourself.
Yeah. That's a good question. I've worked with other business owners who've been my bosses and partners along the way. And, they would often say to me, it's kind of a lonely chair to sit in, to be the founder and CEO and the bank account backing up the firm. And as a minority owner along the way and sitting in those meetings and in the cabinet, if you will, I think I, felt like I understood what it was like to sit in that chair. And they would always kind of, smile at me and say, sure you do. Right. And now that I'm in that chair, I understand that they were right. There are dimensions to being the founder and the bank account backing up the business that I couldn't appreciate when I was a minority partner. And right now I don't have employees to be responsible for, but I'm sure there's another whole dimension that will go along with that as we add going forward. And I think I keep reminding myself that we're in the good old days right now. We're nimble. We're small and growing, but we're able to be agile. And when I uncover an opportunity, we're able to pivot, towards it and go. I understand in the future it'll be harder to move a whole organization, to take advantage of a strategic opportunity. But I intend, both with structure, strategy, and sort of our value and culture, to continue to be nimble if we uncover opportunities. But I guess the weight, in my case with a family to support, of recognizing that this has got to work, and there are real consequences if it doesn't. It's not like, I'll just go get another job. I mean, I could, obviously, if that ever were needed, but we're well beyond that now. We've burned the lifeboats, and so recognizing the weight of that, I guess, has been something that I maybe suspected, but now can feel in a much more tangible way.
Yeah. I think it's always great to start a business during turbulent times. We started our firm in 2008, right at the beginning of the great financial crisis. And you can build from, in tenuous times, people are making changes. Like what worked before suddenly doesn't work very well.
Yeah.
And there's room for change. So I think your timing is excellent. I guess that leads into the question, how do you see the world now? And how do you see it for your firm? And maybe how are you investing around that?
Yeah. Well, to your point, I'm not comparing what has gone on with the great interest rate raise of 22, 23 with what you guys lived through in 08, 09. But it certainly has been a turbulent time. And, the stock market went in all sorts of sideways directions and downward directions, right in the moment where I was launching the firm, which, made the conversations with finicky existing clients pretty sensitive around, hey, I'm going to take a bunch of risk on your setup in addition to whatever's going on in the world. But I think it also showed me that I could, persevere and be okay with putting what we had to offer out there in the world, recognizing that maybe not everyone is going to pick that up, and some people out there in the world might reject it, and that's okay. And also recognize that there's real value to be offered, even in a moment when the stock market's not being cooperative. One of the ways we're managing around that is by offering additional opportunities to invest in some less correlated assets and different types of things. But yeah, right now as we sit here in October 2023, we're at an interesting spot where we've seen the core Fed funds rate go north of 5%, and potentially tick up 1 or 2 times more before this is all said and done. And right now the buzzword or buzz phrase is higher for longer, which is going to have all sorts of pressurizing effects on the broader economy and on markets, not all of which are easy to foresee. Some of the ones that we can foresee is that there's a whole raft of commercial real estate out there that's going to come under a lot of pressure when it comes time to refinance, right? That I think is going to create some pretty interesting buying opportunities for investors in TOR Partners Fund 1 and Graceada Fund 4. I know you guys are excited.
Super excited.
And we are as well, but recognizing also that there's going to be some disruption in some of the financial instruments that have been backing some of those parties that are going to come under pressure, right? And one thing that we're seeing that's disquieting a lot of market observers and participants is that there's been some hesitance in market participants to continue buying all the treasuries that the U.S. government is putting out there. This year, we're going to run as a country a $1.7 trillion deficit on top of many, many years, in the past of running similar deficits. And historically, the government has been able to put out as many treasury bonds as it wanted to finance its activities, and the world just snapped them up. We're seeing less capability and interest from a host of buyers to pick those up, at the sort of the going rates, and so we've seen yields really spike and prices drop in treasury bonds and in a number of other places in the bond market. I would argue that on a long-term basis, that creates a pretty interesting buying opportunity to move into bonds right now and into credit, but also it bespeaks the possibility of there being a limit to how much debt the U.S. government can put out there in the world and the broader world's appetite and ability to soak that up. That is potentially a really threatening issue. And so it may not be this market cycle that dynamic comes to a head and causes bigger disruptions in markets and economies, but I feel like we can see that scenario from here, and it's an issue. And potentially the next market cycle around, the government has to refinance even more of its debt at higher interest rates. And there's a lot of strain that the baby boomer generation is putting on, entitlement programs like Social Security and Medicare, pension funds at state and municipal levels, and any shock to the system that might happen at that same time. We could be in for some real disruption. It's been a bedrock of our financial system that the U.S. government can put debt out into the world, and the full faith and credit of the United States behind it. We can sort of count on that as the risk-free rate. Any disruption to that is going to be hugely disruptive to everything that's going on. Yeah. And so there's some questions about, how to hedge risk and participate in a world where that's the case. I'm not super concerned that we're going to see a breakdown in that pattern this cycle, but I think market watchers who are paying attention can see the possibility of that fundamental pillar being disrupted. And we all have to take a hard look at, all right, how do we invest and help our clients if that assumption is no longer unquestioned? Yeah. More work and thinking required there, but we need to be doing that work as we look at the next, 5-6 years, and we move into that period from 2029 to 2036, when the biggest part of the baby boomer draw on public finances is happening. And also we're sort of that much farther down the road on the fundamental imbalance between revenues and debt that our government and lots of other governments are putting out there in the world. And especially if we're in a world where the Chinese economy is slowing because of some of their imbalances and demographic issues, it could be a different world than the one we've been living in.
Right. Let me throw you a curveball. It's a little bit of a variation on the last question. In fact, earlier in this interview, you mentioned having a superpower. Let's pretend you have another superpower, and that this is you have the ability to talk to your future self 5 years in the future. So we're 2028.
Okay.
And your future self's sitting where I'm sitting, and you can ask advice from your future self. This is really an exercise on forecasting or forward thinking. Yeah. But what would your future self tell you that it knows that you don't know right now? And by that, I mean, what are some things that would say, do this? And what are some things that would say, don't do this?
Yeah.
And also, so some of that might be around investing. Some of that might be more personal on the firm side.
Yeah.
But what would your future self say to you?
I suspect one already that my future self would say, and so maybe this is cheating because I've already been thinking about it. But as we sit here, I've done a really good job of outsourcing a lot of the core administrative functions of the business, and there are absolutely some opportunities to be more efficient and get better scale and leverage out of some of those type of activities. But at some point in the next year or two, I'm going to run into the limitations of what one advisor sitting in the business can do inside TOR Wealth Advisors and TOR Partners. I suspect 2028 Nathan would say to 2023 Nathan, don't be afraid to take further steps to focus on what you, Nathan, are really good at and really enjoy doing that only you can do, that really move the needle. And incur the cost with the risk that goes along with that extension to get other people and other institutions to do the things that you currently do that are not your superpower and your core move the needle things. I'm approaching a space sometime in the next 6, 9, 12 months, and the fact that I can say that now means I'm probably about there, but I just don't want to admit it yet, that I need to do some things to allow the firm to scale and to delegate and get some of those things off my plate. Right now I wear a lot of hats. I think that'll always be the case, but I could pick out 1 or 2 hats to hand off, and there's some expense around that. So that's definitely one, right?
What about on the investing side? What would your future self say? Look, you're not going to believe this, 2023 Nathan, but like this happened. You weren't this happened. What's that thing?
So the sort of the stock industry answer would be, stay diversified.
Yeah.
Right. And make sure that we've got exposure to different types of risk in different geographies and different industries and different asset classes through different channels. So I think that's an easy answer to say. One of the things that I've continued to observe the longer that I've been in the industry is that discontinuous change and presumably value comes from a relatively small set of companies that have figured out a way to take a technology or an idea or a model and apply it in a way that that drives growth and profit. And I'm not talking about the sort of the hype of you pick it, crypto, Internet of Things, AI, self-driving autonomous EVs. All of those things are real and are going to matter, but I'm talking about where the value creation is happening as opposed to the hype of the thing and what it might mean in the future. Having some investment bets in the places where those things might emerge, I'm a big fan of asymmetrical returns, right? And so if there are opportunities, and AI and self-driving EVs could be 2 examples of those things, right? Right now in our investment portfolios, we have an allocation to lithium and battery tech. Now this is the part where I have to say as an RIA that this is not an investment recommendation. I'm looking at all the cameras here. This is not an investment recommendation, and all investments carry risk of loss. No guarantees of returns. But I think that's an example of a place where participating, could lead to dramatic upsides. And the downside is sort of relatively similar to the downside in other types of investments. And so having appropriately sized allocations to the places where it is possible, we might judge it somewhat more likely, where that discontinuous improvement, can happen. AI I actually think is an example of that. And the question is to figure out how best to do that, right? Because there's also a lot of FOMO driven, we got to have, coverage in AI, everything. Well, what does that really mean in terms of value creation? Right at the moment, it's been, if you're a chip maker, that is supplying companies that are doing AI, that's been, a good place, at least earlier this summer. The question is, where's the value creation going to happen in those spaces? And so having some allocations to those places that could have that sort of upside to me makes a tremendous amount of sense. And I think the downside, is potentially asymmetrical. And so we don't get, way out over our skis where we're no longer participating in the broader market with our public market investing, but having some of those strategic allocations to me makes a lot of sense. And so I think 2028, Nathan would say to 23, Nathan, make sure to continue to spend time educating yourself and identifying where those places might be, and have the conviction to understand that, that it's not a short-term type of a bet, but to stay with, identify and then stay with some of those opportunities through market cycles where value creation can happen, and participate in that upside. I think that sort of value creation core idea set is something that's going to fare well even as broader markets are buffeted, even if we talk about some of the things that I'm concerned about, that I mentioned in sort of the broader economic cycles that we're going to be facing over the next 10 years. Those core value creation pieces are still going to have value and create value.
Nathan, we've been talking internally about what attracts RAs to invest in our firm versus Blackstone or Brookfield or other publicly traded REITs or other opportunities. Maybe you can talk us through your thought process and how you came to that decision.
Yeah. Well, to be clear, I think there absolutely is a role for private real estate, and opportunities now are emerging to invest in these semi-liquid, evergreen, interval type funds, and and we offer that to clients both in private real estate as well as private credit and private equity for appropriate accredited investors or qualified purchasers. I know you guys have looked at your strategic path forward, and there may be a fund type structure in your future as well. I think that makes a lot of sense for making what you're doing accessible to more potential investors. Whether it's real estate, venture capital, angel investing, one of the things that I've observed is that higher net worth clients with a degree of sophistication and some assets, they suspect that there's a way to invest that's smarter and potentially better than what's available to Joe Q public. Mm-hmm. And there's a real, I would characterize it as an emotional desire to have access to the exclusive or better thing, and a corresponding fear of missing out of what my peer group or other sophisticated people are doing that maybe I don't know about or I'm not doing. And that can drive some interesting and not always productive behavior. I see some clients and also, potential or future clients a lot of times are engaged in putting, certain amounts of dollars into, these more exclusive or harder to access opportunities. And their processes for making these decisions oftentimes aren't very good or very robust. A lot of times it's just, do I trust the person that told me about it? And they don't really have a good due diligence process. Or any process, except for just looking at the deck and maybe asking a few questions. And so that's one of the values that we bring as part of these family office services, is to really help people go through a due diligence process, generate questions, understand appropriate valuations, deal terms, and also how it fits into their picture, both in terms of their assets and in terms of their risk tolerance and what they're comfortable with and know about. My takeaway from being in this space is that clients are going to make some of those, potentially exclusive and secret and upside deals, regardless of whether they have a good process or not. They might make fewer of them if they don't have a good process, or, but more to the point, I think they potentially make not such great decisions. Mm-hmm. And so if I can help be in a role, to my earlier comments about, mission and strong communities, where they can make really good, high quality decisions in those spaces and scratch that itch of, I've got access to something cool and special that not everyone has. And also that fear of missing out, idea that other people are in this and I'm not. If I can help clients make their portfolios of those types of deals really high quality and they get returns, and the businesses that they're investing in do well and generate employment and generate more dollars in our community, then that's a really valuable and on mission thing for me to be able to do. And it also, it helps the clients, totally scratch that itch and have good outcomes in the process, and feel not only really smart when they make the investment, but also really smart when they see how it does over time.
Yeah.
Right. Because you think to the people that you talk about in your life, the investments that they make, you definitely hear about the winners,
Right.
that, down the road, something good happened and they're like, hey, I had an exit. But you also hear about the ones at the moment of the investment, especially after the deal's closed, like, oh, I got in this thing, it's closed now, but I got in this thing and it's amazing and it's going to go great. If it doesn't go great, you never hear about it again.
Right.
But in the moment, they had access to that thing. I want that conversation about the thing they had access to be just as positive on the back end several years down the road as it was when they were, they were excited at the initial idea. And so I think that is maybe a little bit of an underrated reason why high net worth clients invest in these sorts of spaces. And we can make that process better for them and for everybody else that's affected.
I guess investing's more than making money. It's a personal thing. It's like a suit you're wearing or a costume you're wearing that reflects on your personality and who you are as a person. And scratches childhood itches and
totally
all sorts of itches.
I love that analogy you use. I see some people use their money and the way they talk about their money and their investments as a mask.
Yeah.
And I also see people, use it as a tool, if you will. And you can use tools to do really productive things.
Yeah.
And so conversations about money and investments can be about, like we're talking today, making it a bigger, more successful pie for all of us to get a slice. And then I also see them use as a mask to hide and to represent and to do things that maybe are not so healthy. And I think if we help make good processes around investing and investment decisions possible and accessible, by our example and the way that we carry ourselves, we can help our clients be more in that authentic vulnerability sharing. This is a tool for everyone to use to benefit from type of a place, as opposed to that mask and sort of shadow reasons for.
Well, and you can probably see their blind
money
spots that they might be missing.
Yeah, and I have my blind spots as well. But I think if we do more of that sharing with each other, we're going to make better decisions.
Thank you for listening to Durable Value, an investors podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GraceadaPartners.com, where you'll find more information, investors tools, case studies, and more. This podcast is hosted by Joe Muratore and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.